Hi, welcome to the Just Word podcast once again. It hasn't been a really good American stock market the last month or so. And so I thought we'd get an expert to come and join us. Sam Stovall is with CFRA Research, where he's the chief investment strategist, and he joins me right after this break. Sam, I haven't seen you in so long. Great to see you again.
Good to see you, Pat. You haven't aged a bit.
Thank you. And the same back at you, man. Listen, before we get into what's happening with the American stock market, I do want to ask you one question. It's almost personal because I know you're so associated to the Standard & Poor's 500 index. But whenever people talk about the American stock market, they talk about the Dow Jones. The Dow Jones is only 30 stocks. Why don't people give the respect to, or do you think they do give the respect to the S&P 500?
Well, Pat, I think it depends on who you're talking to. Those in the industry will typically refer to either the S&P or the NASDAQ as the primary benchmarks of interest. However, if you're dealing with your general news and they move to the business section, then they'll mention the Dow for a couple of reasons. I think, first off, it's the sentimental favorite. It was initiated back in the mid 1890s, so it's been around a lot longer than the S&P 500, which was started in 1957, even though it borrowed an index that was started in the early 1920s. And also, let's face it, there's about a 93% correlation between the S&P and the Dow.
Oh, okay. So it gets enough respect where it needs to be respected, I guess. Talk to me about what's happening in the American market, because when you think about what's happened in the last 6-8 weeks, even, UAW strike, student loans having to get repaid, the debt ceiling was just addressed recently, yesterday. So there was a lot that were headwinds, if you will, in the market. Is that what's going on?
Oh, yeah, a lot of headwinds. And I think a lot of investors are still sort of deciding, is this just a very long fake out of the bear market that is yet to recover all that it lost? And I think we're in a new bull market. We did advance 20% off of the October 12th, 2022 low. We did that on June 8th of this year. And a lot of technicals as well as historical data hinted that 2023 was going to be a very strong year, and it has been, at least through July 31. Then the seasonal kicked in, and the old saying of sell in May, well, it really applies more to the third quarter in general and August and September in particular. And then when it comes to October, which is 35% more volatile than the average for the other 11 months of the year, people start to say, okay, well, then there must be different this time. Something must be going wrong. I just find it very interesting that people are always willing to say it's different this time when they're dealing with a down market, but it's never different this time when they're dealing with an up market.
You're absolutely right. Human psychology, Sam. Okay, but let's talk technicals just for a second, because the trend line has been up for a long time for the S&P 500, and it looks like it's breaking down. I read your most recent report, and you were talking about Fibonacci's. Now, it's been a long time since I talked Fibonacci's, but it seems that the market is really on a precipice right now and could decline sharply.
Well, I think that's the worry that investors have right now. When you look at the overall trend lines that are connecting the bottoms in March or in August of this year, also looking at the 200-day moving average. Yes, I learned how to spell Fibonacci just a little while ago. And a 38% correction brings us to around the 4,200 level. So that's an important level. Listening to other technicians who are talking about a head and shoulders pattern that has been broken, that measured move to the flip side would imply a drop to about 4,100. So, yeah, I think a lot of people are very nervous as to how far down it's likely to go. But I can't help but think of the presidential cycle as well, which offers a bit of euphoria.
Euphoria, yeah. People don't know. This broadcast is mostly for Canadians, not exclusively. People in Canada aren't aware that the markets are so sensitive to what happens in the presidential races. What kind of market rallies do you seem to get during presidential election years?
Well, the fourth quarter of the pre-election year, so meaning this quarter, going back to World War II, the market on a total return basis gained nearly 6% and never declined in the first term of a president's administration. So essentially saying that the market more likely than not expects the president to be reelected and typically follows some fairly weak numbers in the third quarter in general, August and September in particular, especially after having a more than 10% advance through mid-year as we saw this year. So obviously it's not a guarantee, but it is sort of a comforting statistic.
Okay, but there is almost a guarantee out there. When short-term interest rates are higher than long-term interest rates, what they call the inverted yield curve, it typically means bad news for the stock market, doesn't it?
Yes, and you can add to that, whenever we've had the year-on-year CPI exceed 6.5%, we have typically fallen into a bear market with a recession. Whenever leading economic indicators were negative year-on-year, we ended up with a bear market and recession. Also looking at a earnings recession, meaning more than 2 quarters of year-on-year declines in S&P 500 earnings. We've already had at least 3, and this quarter right now is expected to be down 1%. But if it follows history, meaning that 54 of the last 56 quarters, we had actual numbers exceed end of quarter estimates, implying that management does a very good job of managing expectations, then this is probably the first quarter in which we're emerging from that earnings recession. But you're absolutely correct that also is an early warning signal for recession. And inverted yield curves, basically, even if your brother-in-law is a banker, he's not going to lend you money at a loss. And usually that's what happens when the short rate, or the amount by which bankers pay people to deposit money, happens to be higher than where they would lend the money. So usually the bankers pull back on their lending practices, which slows the economy. We do think we're likely to see 1%, sub 1% growth in the final quarter of this year, first quarter of next year, but our economists are still holding out for a soft landing.
Yeah, but what I'm hearing, though, is a recession, and it flies in the face of jobs, because it looks as though jobs seem to be increasing. Is that typical?
Jobs increasing ahead of a recession? No, that's not typical at
Right.
all. And I think that, because of COVID, because of the government's response to COVID, the people's cabin fever that they want to dispel, that's really turned a lot of market adages, seasonality, cycles, et cetera, on their head, turn them upside down. And maybe this is one of those times, because of the post-pandemic response, that could maybe delay when we end up having the recession. I mean, we're eventually going to have a recession. It really just depends on how far since the beginning of the inverted yield curve.
Okay, then the question is, if we do have a recession, and all the signals point to that happening eventually, can the stock market still go up? And that's based on, hope for future earnings, or a multiple recovery. In other words, the price compared to the earnings improving. What do you think? Valuations, in other words.
Well, first off, valuations traditionally expand in the beginning of a new bull market. Going back to World War II, the PE multiple expansion averaged about 22% between the bear market bottom and the 20% advance, which signaled that it was a new bull market. Usually because prices lead fundamentals, the price movement tends to advance in anticipation of the earnings growing. 2024 expectations are for all sectors to post positive results, more than half of them in double-digit territory, with the S&P 500 up about 12% on an earnings basis. If that is incorrect, if the economists are incorrect, if the trend lines performances are incorrect, then yes, you could say we'll probably fall into a recession with a bear market. But I'm usually pretty slow to say, sell everything and run for the hills, because 80% of the time since World War II, the S&P has posted a positive total return in those calendar years. Also, Americans are optimistic by nature. If you are a bear and wrong, you're ridiculed. If you're a bear and you're right, you're hated.
True. And I've seen that many a time myself. Okay. Suppose, you were saying that the market could go down to 4,200 or 4,100 on the measurement. Suppose that the economy is recovering. How quickly does the stock market recover, and what kind of percentage moves are we looking?
Well, we are now almost 7% down from the July 31 high, actually through the end of September. The average decline following the 20% advance off of a prior bear market low was about 10%. So it's like the messenger from Marathon who, instead of saying, rejoice, we conquer, says we're now in a new bull market. Yes, they sort of stumble out of exhaustion, but they don't die. Bull markets tend to continue to advance an average of 18% 12 months after we have recovered by 20%, called ourselves a new bull market, and then digested some of those gains. We are then higher by 18% after hitting that 20% threshold. So, except for the bull market of 1947 through 48, every other bull market continued to advance. And I think this one will as well.
Yeah. So, despite all that bad news that we have out there currently, or possibly in the future, and I know you're not a financial advisor, but you would see this as a potential buying opportunity just to take advantage of what could come.
Exactly. I'm not being a total Pollyanna. When life gives me lemons, I do make whiskey sours. But I do acknowledge the fact that, yeah, there is a pretty high wall of worry, but the market usually climbs that wall of worry. Maybe this ends up being like 1984, like 1992, where people felt we were in a recession, but really it was more of an economic slowdown from which we recovered. So I think that there's still more volatility ahead of us, but I do think that we will end up with a favorable move in the final 2 months of this year.
Are there any telltale sectors, if you will? I don't know, airlines, railways, oil and gas, any sector that seems to lead the way so we could get an indicator?
Well, leading the way on the downside, the old adage is when the going gets tough, the tough go eating, smoking, and drinking. And if they overdo it, they have to go to the doctor. So typically consumer staples, healthcare do well. Also for utilities, because you have to continue to heat, light your home, etc. Well, those groups are not doing well at all. That investors are still focusing more on the cyclical plays, energy, industrials, communication services, and to a lesser extent in the near term, consumer discretionary and technology. But look at a continuing relative strength for those sectors, either on a month-to-month basis or on a trailing 10-month basis, which is equivalent to a 40-week or 200-day moving average. And you still find that investors are gravitating toward communication services, technology, and to a lesser extent, consumer discretionary.
Yeah, but it's really difficult, at least in my mind, to buy a sector. Diversification, I guess, is the key of the S&P 500 because you do get 500 stocks. Is that the going line?
Yes, and if you are looking for an area into which to diversify that has been beaten up and is actually trading at a very steep discount, I would look to the S&P's mid-cap 400, small-cap 600, and to the developed international shares. Mid and small cap stocks here in the States are trading at a 30+% discount to their relative PE average going back over the last 20 years. Ditto for the developed international. You might have to wait a while, but these stocks are trading at about a 20% discount to their relative PE versus the S&P 500. And the international stocks do tend to offer a higher dividend yield, so you can get paid while you wait.
Are the international stocks offset for currency risk?
Well, you are adding some currency risk, and certainly as the Fed continues to raise interest rates, the dollar remains fairly firm and starts to creep a little bit higher. Also, with the the 10-year yield looking so attractive that attracts money from overseas. They have to buy US dollars before they can buy the stocks or the bonds. And yes, that tends to support that. But to your case, if we do end up in an economic slowdown, then certainly the Fed will stop raising rates. The Fed may have to start to cut rates, and that should cause the 10-year yield to reverse course.
Okay. Only time will tell, Sam.
Only time will tell.
Sam Stovall, CFRA Research. Sam, thanks yet again to chat. Maybe we'll check in with you in a year's time and see how it all played out.
Yep. Look forward to it. Good to talk to you again, Pat.
Thanks again, Sam. Bye.